You finally have $10,000 sitting in your account, and now comes the part nobody prepares you for. Where do you actually put it? One stock? An index fund? A few different companies? Maybe you wait for the market to drop. And suddenly having $10,000 feels less like an opportunity and more like a decision you can't afford to get wrong. Picture handing that exact $10,000 to Warren Buffett and saying, "You have to build the portfolio yourself. It's 2026, what do you buy?" The interesting part isn't which stocks he would choose, it's what he would refuse to buy, and the reasoning behind every dollar he puts to work. Because if there's one thing Buffett's career has shown, it's that knowing what to ignore can be just as valuable. Chapter 1. What Buffett would probably refuse to buy. Let's start with the part most people would probably get wrong. If you gave Warren Buffett $10,000 today and asked him to build a portfolio, he probably wouldn't start by asking, "What's going up the most?" He'd start by asking a much less exciting question, "What can I understand?" That distinction matters, because when you have $10,000 sitting in cash, the internet gives you thousands of possibilities. AI stocks, crypto, dividend stocks, the latest company everyone on social media is talking about, and every one of them comes with a story. That's the problem. A good story isn't necessarily a good investment. Buffett has spent decades warning investors about the danger of investing in businesses they don't understand, and there's a reason for that. When you don't understand how a company makes money, you can't properly judge what it's worth. You can't easily tell whether its competitive advantage is durable. And when the stock eventually falls 30 or 40%, you don't know whether you're looking at an opportunity or a warning. That's when emotions take over. You start watching the stock price instead of the business. You check your phone. You look at what everyone else is doing. And eventually, the original investment thesis disappears. You're no longer investing, you're reacting. Buffett's approach is almost the opposite. He has repeatedly emphasized staying within a circle of competence, an area where you can understand the economics of the business and make a reasonable judgment about its future. That doesn't mean you have to understand everything. It means you have to know what you don't understand, and that's a surprisingly powerful skill. Say someone offered you a stock that could potentially double in a year. Sounds exciting, but then they tell you the business model is complicated. The future depends on assumptions you can't evaluate, and nobody really knows what the company will look like 5 years from now. Would you still buy it? A Buffett-style investor might simply say, "I don't know," and walk away. That's not weakness, that's discipline. In investing, saying, "I don't know," can protect you from losing money you never needed to risk. This is especially important with a relatively small portfolio. If you have $10,000, a major mistake isn't just a temporary setback, it can erase years of progress. Lose 50% and you're down to $5,000. To get back to $10,000, you don't need a 50% gain, you need a 100% gain. That's why Buffett's famous emphasis on avoiding permanent loss matters so much for someone starting with limited capital. The goal isn't to turn $10,000 into $20,000 as quickly as possible. The goal is to build a portfolio that gives your capital a reasonable chance to compound for many years. And that immediately eliminates one of the biggest mistakes beginners make, confusing excitement with opportunity. A stock can be exciting, a technology can change the world, and the investment can still be terrible if the price you're paying leaves you with no margin for error. That's the part that gets lost when people ask, "What would Buffett buy?" Because Buffett isn't simply looking for great companies. He's looking for a combination of quality, understandable economics, durability, and a sensible price. And once you understand that, the $10,000 portfolio starts looking very different. Because now the question isn't, what are the 10 best stocks in 2026? It's, what deserves a place in this portfolio at all? And that brings us to the first real decision Buffett would have to make before buying a single stock. Chapter 2. The first question isn't which stock to buy. Before Buffett decided where to invest the $10,000, he'd have to answer a more basic question. Should all $10,000 actually be invested? That sounds obvious, but it's one of the most important questions a new investor can ask. Because investing money you might need next month is completely different from investing money you can leave alone for 10 years. Say you've got $10,000 in your bank account. You invest the entire amount. 6 months later, your car breaks down, or you lose your job. Suddenly, that investment isn't long-term money anymore. You need the cash. And if the market happens to be down 20% when you need it, you may be forced to sell at exactly the wrong time. That's not a failure of the marketplace. It's a failure of matching the investment to the time horizon. And this is where a Buffett-style mindset becomes useful. Buffett has repeatedly emphasized the importance of having enough liquidity and avoiding situations where you are forced to sell good assets at bad times. So, if we're building a hypothetical $10,000 portfolio based on Buffett's documented principles, we shouldn't automatically assume that all $10,000 belongs in stocks. First, we'd separate financial security from long-term investment. If the $10,000 represents someone's entire emergency savings, putting all of it into stocks would be a very different decision than investing $10,000 they genuinely won't need for years. That distinction changes everything. Because once your short-term financial needs are covered, you can think differently about market volatility. A 20% decline stops being an emergency. It becomes something you can potentially sit through. And that matters because Buffett's philosophy depends heavily on patience. You can't be patient with an investment if you're worried about needing the money next week. This is one reason investing isn't just about picking assets. It's about building a financial structure that allows you to stay invested. Think about it this way. A great investment strategy that forces you to sell at the worst possible moment isn't actually a great strategy for your situation. The best portfolio is one you can emotionally and financially hold through difficult periods. That's why the first question isn't which stock to buy, it's can I afford to leave this money alone? If the answer is no, the portfolio may need to start somewhere other than the stock market. But let's assume the $10,000 is genuinely long-term capital. No high-interest debt that needs immediate attention, an appropriate emergency reserve is already in place, and the money can stay invested for years. Now, the interesting part begins, because Buffett has another problem. There are thousands of publicly traded companies. He can't own all of them, and with only $10,000, he doesn't need to. In fact, owning too many companies can create another problem. You may end up owning businesses you never really studied. You might think you're diversified when you're actually just spreading your uncertainty across dozens of stocks. Buffett has often argued that investors who truly understand what they're doing don't necessarily need to own a huge number of companies. But that doesn't mean everyone should build a 5-stock portfolio. For most ordinary investors, broad diversification can reduce company-specific risk and is often much easier to maintain. That's an important distinction. Buffett's personal investing style isn't automatically the correct portfolio construction for every individual investor. We're not trying to copy his portfolio, we're trying to understand his decision-making process. And that process starts with one simple principle. Don't put money at risk just because you have money available. Put money at risk when you have a reason, a time horizon, and a level of risk you can actually live with. Now, assuming our hypothetical investor has cleared that first hurdle, we finally get to the question everyone came for. What would Buffett actually want to own with that $10,000? And the answer starts with a type of business he spent his entire career searching for.
Chapter 3. The kind of business Buffett would want to own. Now assume the $10,000 is truly long-term money. You don't need it next month, you are trying to double it by next year, and you're willing to watch the market fall without immediately selling. Now Buffett can finally ask the question he cares about most. What kind of business deserves my money? And his answer isn't simply a company with a great stock. Because Buffett doesn't really think of himself as buying stocks. He thinks of himself as buying pieces of businesses. That sounds like a small difference. It's not. When you buy a stock because you think its price will rise, you're focused on the market. When you buy a business, you're focused on the economics behind that price. How does it make money? How predictable are those profits? How much capital does a business need to keep growing? Does it have an advantage competitors can't easily destroy? And, perhaps most importantly, what could this business look like 10 years from now? That's the kind of thinking Buffett has used throughout his career, and it gives us a useful filter for our hypothetical $10,000 portfolio. First, we want businesses that are understandable, not necessarily simple, understandable. There's a difference. A company can operate in a complicated industry and still have a business model you can explain clearly. If you can't